welcome everyone to today's webinar. We're really excited to have y'all here. We got people still trickling in, so we'll go through some basic introductions here to start, and then we'll get into the meat of things. So today, got a great speaker, Brett Kunshek. He is the head of our options and structured notes. Really great content that we're going to be going through today. As you can see here, we're going to be talking about generating alternative cash flow in uncertain markets. A lot of topics that are top of mind. We've got geopolitical uncertainty with wars going on overseas. We've got a political landscape that's changing. All of that can have a lot of effects on markets, and of course, how we should be investing and how we should be protecting our assets through those markets. So as we go through that today, if you have questions, and I'm sure you will, feel free to throw them in the Q&A. We will do that at the end of the presentation and go through as many questions as we can so everyone has all the answers that they need. For the meantime, we'll go ahead and let Brett jump in here, introduce himself a little more, and get into the content we're going to be discussing today.
Great. Thanks, Dylan. As Dylan said, I'm Brett Kunshek. I head up the options and structured notes team here at Mariner Wealth Advisors. I've been at Mariner since 2010, and during pretty much that entire time period, I've been either trading, creating, or managing option and structured note strategies for our clients. And this is one thing that makes Mariner quite a bit different from a lot of the competitors out there, frankly, is that we do have a dedicated in-house options team that does this for clients. Most of the time at other firms, it's an outsourced function. So why do we have that? Why do we think, using options and structured notes can be a good thing, right? I feel like a lot of times when I bring up, hey, options can be a complement in your portfolio, a lot of people initially go to, ooh, options. That must be risky, right? And options can be very risky. A lot of the stories you'll read online are about people kind of blowing themselves up with options, right? And effectively doing very speculative, risky things. But the beauty of options is that, yes, you can do those risky things, but you can also do very conservative things and everything in between. So options and structured notes are very similar in that you can readjust that risk reward structure instead of, say, just owning a stock. And if it goes up $1, you make $1, and it goes down $1, you lose $1. We can readjust those parameters to maybe be something more that a client places more value on. Maybe a client needs or wants more income or downside protection, or maybe the client does want to enhance the return of their portfolio, but in a prudent way. So we really take a look at options through the lens of the wealth advisor, right? We use them in a wealth management perspective to adjust that portfolio of the client to maybe create something that you can't just do with your more basic investments of stocks, bonds, and cash. Now, today, we're going to specifically talk about generating cash flow. Like I said, with options and structured notes, you can slice and dice it a million different ways and get very complicated. But we're going to narrow it down today and really talk about two different strategies that we have found to be very effective and attractive to our clients to create that cash flow. Now, you say cash flow, income, yield. I'll use those words synonymously throughout the presentation here. And a year ago, 2 years ago, if you would have told me, hey, people can earn 5% on their cash, I would have probably said the demand for, yield is going to go down, right? Because cash isn't trash anymore. The old saying was going when, you're getting nothing for your cash. Now you can put it in a money market and get that 5% rate roughly at current levels. So why do you need to do something else? Well, amazingly, just given all the uncertainty in the marketplace, inflation, people have increased their demand, the attractiveness of income strategies. So we've actually seen a lot more clients coming into the types of strategies I'll be talking about today. And so with that, let's go ahead and get started. And again, I'm not going to dive into very technical pieces. Today's agenda, we just want to give you an idea of the types of strategies that you can use as an investor to create that cash flow, and not just necessarily sitting in cash or high yield bonds or just collecting your dividends. What are those alternative ways that you can generate a high level of cash flow? So today, this top section here, options, we use options. One of the ways we use options to create that cash flow is with cash secured puts. Now, what is a cash secured put? Well, the nice thing about cash secured puts is, especially in this environment where cash is yielding, roughly 5%, is you can keep your cash, stay in your cash, get that roughly 5% yield on your cash, and then we sell puts on individual stocks or ETFs to generate additional cash flow on top of the yield that your cash is getting. So these are designed to generate a higher income level. Anywhere from upper single digits to low double digits is typically our target, depending on the interest rate and volatility environment. So this is a way to enhance your cash flow yield. But the nice thing about cash secured puts is that when we sell that put, we're selling it on a stock or an ETF, but it's going to be below where the stock or ETF is currently trading. What does that mean? Well, you have downside protection as well. So it's not like this isn't taking any risk, but this has protected downside risk. So it's a nice way to add that additional yield, but also have a certain level of protection on the downside. Now, structured notes, the ones I'm going to talk about today, are callable yield notes. Now, we'll get a little bit more into structured notes in the presentation here, just because there's a few more moving pieces to them, and a lot of people aren't even as familiar with those as they are options. But the callable yield notes, you can think about those in the same way as the cash secured puts. So they have the same risk reward structure that we're looking to achieve, right? Downside protection with a high level of interest in those. So you get a coupon in these notes and you have downside protection, and we're only tying these to indices. We do not use structured notes on individual stocks. So in short, they're over-the-counter securities that we purchase. Think from the big banks, the JP Morgans, the Goldman Sachs of the world are the issuers of these types of notes. And then we get a stated coupon with these notes. So that's the basic construct of the callable yield note. Let's go ahead and first off, we're going to go through an example of cash secured puts and what a cash secured put may look like. So on this chart here that you have on the screen, this is just saying that dotted gray line is a stock that is trading at $100 per share. So again, like I said in the very beginning, if you own that stock, you get 1 for 1 on the upside, 1 for 1 on the downside. You just, whatever the stock does is your return. Now, instead of buying that stock for $100, you could keep that money in cash and get the return on your money market at the current rate, and then sell a put on that stock. So here on this $100 stock, in this example, we can go sell one put option on the $100 stock at the $90 strike price. In this example, we would receive about $2.70 per contract, or effectively per share, you can think of it as. So here, one contract represents 100 shares. So in this example, that would effectively be $10,000 you'd have to spend on that $100 stock to go buy 100 shares. Here, since we're selling the $90 strike price, it's only 90 times 100. So that's why it says you need 9,000 in cash, because that's effectively what you would need to collateralize that position. So here we have 9,000 in cash, and we sell the 90 strike put, and we receive $2.70 for that put. Now, you receive that instantly. As soon as we sell that put, you receive that cash. And that's why you see that blue line at a flat 3%, because that $2.70, that is 3% of the 9,000 cash. So you receive that 3% cash instantly. Now, you don't own that free and clear, right? So not until that option expires. Typically, when we sell these, we're going anywhere from 2 to 4 months out in time. 3 months on average is about how far out in time these contracts go. But as long as that $100 stock stays at 90 or higher, you keep that $2.70, plus you're earning that interest on the cash. If that $100 stock goes below 90, then you would start losing, and you don't actually get to a loss position until, in this instance, until you get to 87.30 would be where your break even would be. And below 87.30 on the stock price, you'd be losing. Why 87.30? Well, we sold the $90 strike price, received $2.70 per share. So 90 minus the 270, which lowers your cost basis down to the 87.30. So if you buy the stock at 100 and it goes down $20 per share, now you own that at $80 per share, and you're down 20%. Here, if that $100 stock goes to $80 per share, now you'd be down roughly 7%. So that's how it buffers that downside, right? You have that roughly 10% or so buffer on the downside while receiving that high level of cash flow. So if you can think about the risk here, the risk is that you do this on crazy speculative stocks, right? Or just that the market really goes down significantly, right? So how we manage this, and how I think, the prudent way to do this, is on stocks that you wouldn't mind owning if they did go down. Right now, you don't necessarily want to own them. You don't even necessarily have to intend to own it. But if that worst case scenario played out to where it went down significantly and you ended up owning that stock, then in that situation, you want to be comfortable owning that stock. So if this $100 stock went down significantly below 90, you would begin to lose on a 1-for-1 basis. So that's the risk. So I always like to say this is buffered equity risk, right? This isn't like being in cash and just being in cash, right? This is taking on more risk than being in cash. And it's taking on more risk than just being in pure fixed income, right? Your investment grade fixed income. Because again, if these stocks go down below that strike price, you do incur the losses below that level. So it's a nice way to put it in the middle ground. I always think of this as an alternative from a risk perspective. It's more risk than cash or investment grade fixed income, but less risk than just being in pure equities, because we're selling these puts lower than where that stock's currently trading, and you're getting that high level of cash flow. So off of a strategy like this, you can get your money market rate plus, reasonably in today's volatility environment, anywhere from another 6 to 8%. So, in this interest rate environment and the current volatility environment, you could be in the, above 10% level on your cash flow. Now, that's not necessarily return, because that's going to depend if any of those stocks go below those strike prices. But in today's environment, that cash flow that you would get off of this is pretty substantial and more than double that current cash rate. So that is the cash secured puts. Again, just a way that fits in that middle ground. It's not pure equity risk. You have that buffered equity risk, but it's saying, hey, I would like to get a high level of cash flow. And I always say to clients, hey, if you'd be willing to own stocks, if they go down 10%, would you be willing to own them then? If the answer is yes, then that could be potentially a good strategy to add into your portfolio.
And Brett, to jump in there real quick, just one question I thought would be helpful if you want to back up to the last slide. One question was around the strike price. If you're looking at strike price on these cash secured puts, one, is there maybe additional context for how you determine the strike price specifically that might be helpful for people who may not be familiar with what strike price is and how that determines the numbers that we're looking at here?
Yep. So that strike price, you can think of that as there's lots of strike prices. So on $100 stock, a lot of times it will have strike prices in $2.50 increments below 100. So it may be 97.50, 95, 92.50, 90, etc. It keeps going down. Now, the higher the strike price, the more premium you'd get. So if we move from the 90 to the 95 strike price, you would get a lot more premium than $2.70. But now you're taking on more risk. Now you only have a 5% buffer to the downside. So it's that risk return trade-off. We zone in to where, we have certain parameters we're looking at when we're selecting these, and it's based off of volatility. So a lower volatility stock, we may be a little bit closer to the current price. We may not be 10%. We may be 8% or 7% lower. Now, if it's a higher volatility stock, we may be 11 or 12. So that volatility of the underlying stock or ETF is a big component in us choosing that strike price that we're looking to sell, because we're looking to keep that risk basically consistent across all of our securities, regardless of the volatility of the underlying security. So that's how you can do it, is by adjusting how far you're selling that. But for a client running, that want to do this themselves, there's a lot that goes into it. But you can just think of it simplistically. The higher your strike price, the more risk, but the more cash flow you're going to get out of it, and vice versa on the downside.
Beautiful. Perfect. And with these puts, for example, it allows you, when you sell an option on a put, it allows you the option, aka you can sell the underlying position, but you're not required to, correct?
So with selling the put and being in cash, what you're obligating yourself to do is that put option. It's actually kind of a double negative, because a put option is the right to sell a security at a specified price on a specified date. So that specified price is just your strike price, and that date is the expiration date. So we're saying we're selling the right to sell, meaning we would be buying this stock at that $90 price. If it went to 88 or 85, we would be, and it's there at that expiration date, we would still be buying it at 90. So that's the risk on the downside, is you have to be willing to buy into that stock. A lot of times how we do it is we will buy that stock, and then we'll turn around and do a different option strategy. We'll sell covered calls on the high side. And that's not a strategy we were going to go into today, but that's just another way to continue to get a high level of cash flow while you're owning the stock instead of being in cash.
That's great. That's great. Thank you. Appreciate that.
So that's the high level overview of cash secured puts. Again, it's a way to have that downside protection, but get a high level of income or cash flow. The structured notes that we use and we're going to talk about today have that same risk reward structure. You get a lot of downside protection and a high level of cash flow, but they're a little bit different, and there's some key differences to them. One, they're not options. The options that we trade are listed options on the open market. So just like you can go buy Apple stock on an exchange, you can go buy and sell these options on the exchange. So they're very liquid. So we can get in and out of those positions very easily. For structured notes, these are over-the-counter securities. So we go directly to these banks and we tell them, hey, this is the type of note we want, and we give them all the parameters with one variable. That variable is the coupon rate. They tell us, okay, for that structure that you're saying here, we would give you a rate of X. And that's how those work. Being an over-the-counter security, they're not quite as liquid, but we still do trade out of these, and you can sell this note prior to maturity. So a structured note, again, it's a note. If you buy a note from JP Morgan and it shows up in your account, it would look like a bond from JP Morgan, but it comes with a prospectus. That prospectus details the exact legal terms that they're obligated to pay you out according to at that maturity date. Now, these typically go further out in time. The options we use were a lot of times in that 2 to 4 month range. Here, for these yield notes, we're in the 1 to 3 year range. So it's a much longer tenor on the holding period for the notes than the options. So that's one key difference. Now, these are issued by those issuers, and it's technically senior unsecured debt of the issuer. So we're only using issuers that we're comfortable with. The largest, biggest banks here, mainly in the US, we use some international issuers, but those are issuers that we're comfortable with their credit risk. So we're not using banks that we are not comfortable with. Again, it's all the JP Morgans of the world that we're primarily using for those issuers. Now, how do we get these payoffs, right? How do these notes work? Why do these banks do this? Well, you can think of the banks do this as it's a cheaper funding source for them. Just like they issue debt, just like they take in deposits, they can create these notes and they get that cash. So they're effectively issuing debt. That note that we get, it just has different parameters than a normal bond. So it's cheaper funding for the banks, and they look to make money off of these, right? They charge a fee for us to go buy these notes, and them creating this. There's a smaller fee embedded in this. Now, that's one of the negatives that you may see if you just do a Google search on structured notes, is that they're riddled with fees. Well, they can be, and a lot of the brokers out there do embed large fees within these notes. Here at Mariner, we do not embed any fee in the notes, and everywhere there's a fee, we've driven it down to a very low level, to where these are very competitive with really any other investment as far as the fees that are associated with them. So we really like these, and we like this risk reward structure to where we have it in another version with structured notes, like we do with the cash secured puts. Now, when they create these, they have that zero coupon bond. That's the core of it. And then basically it's an options package that they use to create this payoff structure. So you can really get into the weeds on how the banks do this. But for the purposes of this call, it's their debt they're issuing, and that option structure, or that option package, is what they use to price this and create that payoff. So let's go into example, and I think this will help, just like with the cash secured puts. Here again, that gray line on this one, that gray line is an index trading at 100. So similar to the cash secured puts, it was trading at 100. So I use that as your reference point. On this graph, though, it's skewed further to the right. Now, this note has a 2-year maturity. So much longer than the 2 to 4 months. But by going out that 2 years, what do we get in return? Well, we get a lot more protection. So this note has 25% protection to the downside. So if you'll see that last dot in the example section there, principal protection, 25% geared buffer. So that's where you see on this graph, that gray line, as it's going down, you're still getting your coupon. This note pays a 9% coupon. It's a monthly pay on that 9%. And as long as it's not down 25% or more, then you're collecting that coupon every month. So that green line here is just saying, hey, it wasn't down 25% or more. As you can see, at 75 and higher, you collected all of your coupon. And then the blue line as well, that's just saying, hey, you got your second year's worth. So your total return, if you got all the coupons over that 2 years, is 18%. Now, in the meantime, this is tied to the S&P, the Dow, and the Russell 2000. And so if any of those indexes, if they're not down more than 25%, you get those coupons. But if they're down more than 25%, then you miss out on the coupon, and you would start losing on the principal. So here you see that blue line start going down at 75. What this is saying is below 75, you would start losing on the principal of the note. So if at maturity, and that's only at maturity when you start losing on the principal. So at maturity, if the index is down 26% and you have 25% protection, you'd be down 1.33%. Now, I might be saying, well, why 1.33? Well, you can see that blue line is trending towards that gray line. We created these to lose at a little bit greater rate. Why? Well, to produce the best terms possible. That gives us a little bit bigger coupon by doing so. And so by losing at a little bit greater rate, we can have a higher coupon to the tune of, about a whole percentage point than if we just said, hey, if it's down 26, you're down 1 instead of 1.3. So these have a lot of downside protection, but it's not absolute, right? You do see that, hey, if these indexes go all the way to 0, then you still can lose 100%, not excluding any coupons you receive. Now, I don't want to, make this too fearful because, again, we tie this to indices, the U.S. stock indices as well. We will not use international indices or any type of speculative index. It's always typically going to be the S&P, the Dow, the Russell 2000, big indexes like that. So the odds of these indexes being down, even 40 or 50% are very low. And, if they're down 50 or more, then that's just a very, very bad period. And, is frankly largely been unheard of outside of a Great Depression. So on this graph, yes, you do have all of your principal at risk, but I want to put it into perspective here as far as this is tied to indexes, not individual stocks. So I think that's key. Now, another thing with these types of notes is that this coupon is contingent. What does that mean? Well, I said, as long as it's not down 25% or more, the index, you get your coupon. So in this example here, for simplicity's sake, we're using a 12% annual pay, a 12% coupon rate monthly pay. So you're getting 1% per month. So if the index is not down 25% or more, you get that 1% each month. So month 1, the index was actually up 5% is what that black line is saying. So you got your coupon. Month 2 was a bad month too. It was down 11 because you were up 5. Now you're down 6. So it was down 11. You still got your coupon because you're not down 25% from where you started. Same thing with month 3, month 4, month 5. Month 4, you're down 24, or month 5, you're down 24, but you still got your coupon. Month 6, now you're down 26% and you miss your coupon that month. Same thing with month 7, you're still below that coupon barrier. Month 8, the index comes back up and you begin getting your coupons again. So this hopefully illustrates how these coupons aren't guaranteed. They are contingent on where the index is at. So that is key as far as, having the right frame of mind that you're not necessarily guaranteed to get those coupons. But again, down 25% is a very large move on the indexes. So think of 2022, for example, right? A pretty bad year. The S&P at its lows was down 25% from January to September in 2022. So you might have just maybe missed one monthly coupon in this scenario, but then the index started coming back up. So in that scenario in 2022, if you started, and this assumes you started at the very beginning of the year at the very high of the market, not prior, right? Because prior, it's from your starting point. So if you just happened to buy this note at the very high, you still would have gotten most of your notes. You would have had that protection. It would have just dipped below that level just briefly and then came back up and you would have been getting your coupons again. Actually, about very similar to this graph that we're showing here. Now, I do want to walk through the principle and how that works and how that is at risk. So there's 2 graphs here, and we have a 25% threshold. That's the common threshold of downside protection on the principal. So that principal only matters at maturity. So the note in the account, if the index is down, that note will show down, but if it's not down below that 25%, in essence, if you just hold that until maturity, you would get 100% of your principal back at maturity. So if the note, let's look at this top one here that says above the buffer. If the index is trading above that 25% buffer level, then you would just get all of your principal and all of your coupons along the way, as long as you didn't miss one, if it by chance dipped below that 25% level during the period. So here you can see it was above the level, it finished down 20. So at down 20, you got 100% of your principal back, and you would have got most of your coupons, except you can see just for a brief period there at the end, it dipped below 25%. So again, probably similar to 2022, you may have missed out on a month or two's worth of coupons, but then you would have received some at the end there and then got 100% of your principal back. Now, how it works if it is below that buffer level. So the lowest, so the gray line here, that is the index. And again, you're just collecting those coupons as long as it's not below 25%. But at maturity, this one was down 26%. So that's where you would be down 1.3%. So you would get 98.7% of your principal back. And you would have also received any coupons along the way. So considering this didn't breach that level till towards the end of the life of the note, you would have been more than likely been positive on a total return basis and still gotten a fairly nice return, because this just barely breached that threshold of down 25%. So that's how the principal piece of it works, and whether or not the underlying index is above or below that level. Now, you might be thinking 25%. Some people, I feel like, may think that happens all the time, right? And yes, we were down briefly 25% over the first 9 months of last year. But that, again, that's assuming from the very high point. So what this is showing, this graph here, this is showing a 1-year rolling return on the worst performer of the S&P 500 index, the Dow Jones Industrial Average, and the Russell 2000. And this is saying, hey, what's the probability that even just the worst performer is down 25% or more over any 1-year rolling period? And historically, going all the way back to 1988, that's been about 4.3% of the time. And you can see a big chunk of that occurred during the Great Financial Crisis. So 25% protection on an index is a lot of protection. That's the key thing here. You can see other periods where, it did dip below that, but a lot of times it was just briefly below that and not for an extended period, other than kind of that 08, 09 period. Even if you look at 2020, it spiked below that level just briefly. And then 2022, like I said, it was below it again a couple times just briefly. But overall, 25% is a lot of protection on an index. So we've been talking about cash secured puts and the callable yield notes, and they're very similar. So I wanted to put up this slide that shows, it compares and contrasts the two, right? Again, at a high level, they're doing the same things. They're providing that downside protection and a high level of income or cash flow, but they're doing it in different ways. And the key things is with cash secured puts, a lot of times we do that on individual stocks. Now we can do that on ETFs, whereas the callable yield notes will always just do that on indices. So that's one key difference. As far as the downside protection, the cash secured puts, that's going to be about 10% on average protection. So you have less protection, but it's also over a shorter period, typically 3 months on average. Whereas the callable yield notes, we have 25% protection, so quite a bit more than 10, but that's going out 1 to 3 years. So you're taking on a longer maturity, but you get a lot more protection. So depending on what a client or an investor is looking for, they may gravitate towards one over the other. Another key thing with the cash secured puts is that you can own those stocks or ETFs if it goes below it, and then just own them. Or like I said earlier, you can own them and then sell calls on it to continue to get that high level of cash flow. Whereas with the callable yield notes, those are just settled in cash. You do not own any of the indices with that. It's just while you own the note. So there's some key differences. Again, these are just two ways that we use options in structured notes to create this attractive risk reward structure. And we just wanted to highlight this today because we have had a lot of clients that have been very interested in these types of strategies. And it's something that is unique to Mariner and what we do here as far as having alternatives to generate these different types of cash flows. So with that, that's the high points for today as far as how we look to generate cash flows with alternatives. Dylan, any questions that came in throughout the...
Yeah, we actually had a few that came in that I think are going to be pretty pertinent here. So we'll go through them. And for anyone who's sent in questions, as a note, there were a number of questions just around some rehashing of numbers. We're not going to go through all of those right now because they're all very unique. Hey, what about this 1%? What about that 9%? We will be sending links out for the replay of this webinar. And I'd encourage you to rewatch that for those that had questions about some of the specific percentages and kind of clarifying questions. Brett did a really great job. And again, thank you, Brett. Did a really great job explaining it. Sometimes options can take 2 or 3 listens to have it sink in, as I'm sure Brett could echo with his experience. So feel free to rewatch that. And also reach out to your advisor. Our advisors are all well-versed in the options. We have other specialists within the firm as well that can hop on phone calls with you. So please lean into your advisors, use them as a resource, and let's get into some of these questions. So first one, we talked a lot about downside protection. What happens, Brett, if the index is up with some of these investment selections? We were talking a lot about downside. What happens if the market, instead of going down 25%, goes up 25%?
Great question. Because with these, I do always talk about upside risk as well, right? Because these do not capture the upside in a stock or an index. So that's a key thing. If you're looking to capture that upside, there's a different type of structured note that does that. There's other types of option strategies that would capture that capital appreciation. The two we went over today, the primary objective is cash flow, not capital appreciation. So with these, yeah, there's little to no capital appreciation. Even on the structured notes, there's going to be no capital appreciation. And on the cash secured puts, there's no capital appreciation unless you ended up buying the stock at lower prices and then held it. That's the only way, but then you're not in the cash secured put. So yeah, great question. There is upside risk. If you're really bullish on the market, honestly, this probably isn't the strategy for you, right? You probably need to be in stocks or something that's going to enable you to capture the upside.
Yeah, and that's great. And as a note as well, if there's any content that anyone here would like to see, say structured notes and other types of investment options that are more on the growth side of the curve rather than the downside protection, let us know. Again, talk to your advisor, email us, let us know, and we'd be happy to put those types of webinars together for you as well. Thank you, Brett. So next question is along a similar vein, but when we're looking at, say, on the downside, are there structured notes, for example, how high can a structured note go where that downside protection is concerned? The question, the way they phrased it is, are there structured notes with 100% downside protection and some kind of return? We can't obviously 100% insulate from all risk, but realistically speaking, Brett, how high can that risk protection go before it becomes problematic for any kind of return within the note itself?
Yeah, I mean, there are notes that are 100% principal protected, but like you alluded to, Dylan, you really start to water down the return potential, and then you're not getting a return potential that's really much better than just cash, right? So usually, we're kind of in this 25% range. You can maybe be at 20 to get, more, a higher coupon. But if you want more protection, 30 is kind of that max level. But you can really, at the end of the day, create anything you want, right? To zone in on that level. But we've created strategies here at Mariner. So I think this is another key piece, is we don't think of this as just a one-off trade, right? We don't just go sell one cash secured put for a client. And we're not necessarily looking to just buy even one structured note for a client. We've built out strategies where we have a cash secured put strategy where we'll do this on cash, but we'll sell a portfolio of these puts, right? And then we'll buy a laddered portfolio of structured notes on the structured note side to create more of a strategy than, say, just a one-off trade. So I think that's key to understand as well, as far as how we look at using these, because a lot of people think options more of a trading vehicle, and rightfully so, it can be, but we look at it of how do we create a strategy to create these outcomes that we're looking to create.
And so it sounds like, if I were to summarize it another way, Brett, that it really comes down to what your specific need is, what that end goal is for that need, and your comfort with market risk, how much downside protection you're really looking for, and practically speaking, what the investment vehicle is intended to accomplish, and then finding a marriage between those two to get to the proper solution.
Exactly. And that's how we like to start with it. Hey, tell me what you're looking to achieve. And then if you give me, your objectives, your risk tolerance, and all the details I need, then I can really point you in the right, and the same thing with our advisors, then we can point you in the right direction as far as the strategy that would be most appropriate to achieve those objectives.
Perfect. So next question here, and we've got a few more here that we'll go through. One was regarding the term of these notes that we're talking about. The question is regarding how the money is committed. So when we're talking about these notes, is the money essentially locked up for the term of the note, or is it only committed at the end of that term?
Yeah, good question. So with structured notes, they are a little bit less liquid. And now when I say less liquid, we still do trade out of these structured notes for clients. We trade out of, maybe call it one note a month, not often. We're not looking to do it all the time, but situations arise. So there is a secondary market for these notes. Now, where they're less liquid is you do have to typically get out at, say, 1%-ish discount to the true fair value of the note. So that's the illiquidity. It's not that we can't get out of it. We can, in the vast majority of scenarios, get out of the note. It's just that we're going to have to get out at a little bit of a discount to that fair value. So that's the illiquidity piece of it. Whereas the options are completely liquid, right? They're exchange traded, and wherever the fair value is at that point in time, we can get out of them, right away, very quickly that day. So the notes, it's best for the structured notes to go into them with the mindset that, hey, I'm going to hold this until maturity, if needed. But knowing that, hey, if something does crop up, we do have the ability to exit out of the note if needed.
Great. Now, we had a few questions come in on this. This probably won't come as a surprise, but it's regarding taxes. So question is, how are these things taxed? Don't expect you to go into complete detail here, Brett, but specifically when we're looking at taxes, one of the questions I want to make sure we tackle here is, are there any general tax considerations that clients need to be aware of? And two, are there any potential advantages from a tax perspective when we're working with these types of option strategies and structured notes?
Definitely. And it does depend on the type of option, and the type of note that we're using will dictate the tax status. So it does differ. It's not all or nothing, just one type of taxation. So for these cash secured puts that we were talking about, they would all be short-term capital gains. So they would get taxed at ordinary income rates. So they're not that tax efficient. So ideally with our clients, we like to use, it in an IRA or a qualified account, to where we don't have those tax ramifications, because it is inefficient from a tax perspective. And that's going to be best in that IRA. Now you can get to long-term capital gains tax status with cash secured puts, but you would have to sell that put with expiration a year or longer, and hold it for at least a year. So you can get long-term tax status, but we don't do that. We don't feel like that's the optimal way to run the strategy, just how we built it. So it would all be short-term capital gains. Now on the structured notes side of it, those coupons are all ordinary income as well. So that would be taxed at the ordinary income rates. So same thing there. Those can be held in an IRA as well. And that's going to be the preferred spot form if IRA dollars are available to invest in those notes. Now, we have also created a strategy that creates these coupons in a high level of cash flow, but it gets long-term capital gains rates. So it has the downside protection, gets this high coupon rate, and gets taxed at long-term capital gains tax rates. So especially, those clients in the highest tax bracket, that's been very attractive to those. So we didn't go into it's very similar to the strategy we talked about today. There's a few differences to it. We didn't get into that, but we do have another version, to get to that long-term capital gains tax rate. And that's the main reason why you would do that one over this one. For the growth notes, if you want to capture the upside capital appreciation in an index or in the market, then we're going out 3 to 5 years on those, and those don't have any cash flow, and they're tied to the indices. And a lot of times on those, you get anywhere again from 25 to 30% downside protection. But instead of getting a coupon rate, you get the upside participation. And typically it's a leveraged upside participation. So those are very attractive because it's the most efficient hedged equity type of investment that I've seen. And if you hold those for a year or longer, you get long-term capital gains tax rates. And those are typically, we even go out a little longer on those, typically 3 to 5 years. We didn't talk about those today because the topic was cash flow, and those have zero cash flow. But that's just another example of a type of note that we do that is taxed a little bit differently.
That's great. And it's like you said before, Brett, it really comes down to what's the existing need, what is your risk tolerance, and then based on that, what is going to be the best solution. Yep. And it sounds like from a strategic perspective, part of the reason that you're not wanting to push some of these cash secured puts, for example, out to long-term capital gains is because from a strategic standpoint, we want to keep it in that shorter bandwidth of that 2 to 4 month window, because it's going to be better overall for the strategy, even beyond what potential tax savings you could have long-term.
Correct. I didn't want to complicate it during the presentation, but we actively manage all of our option strategies. So we stay shorter term, because if that stock goes down and it's around that strike price, we will look to exit that put and then move it to an even lower strike price and manage that risk on the downside. If we go out a year or longer, it really reduces our ability to manage that risk, and we're just kind of stuck in that option. By staying shorter term, we will exit out of them and manage them to get the best, create the best risk return profile possible for the strategy. So in essence, that's why we stay shorter term, is giving us the ability to manage the risk versus going out longer term to get the better tax status.
So in essence, what we can do in summary, obviously this can get a lot more detailed, but we can customize these strategies to pair with existing tax planning and financial planning that our clients are doing with their advisors.
Exactly. And I've seen advisors pair these with some of our tax loss harvesting strategies and various things, because they know they're going to be creating income over here, but they're generating losses over here that can offset. Or, we've had clients who have also been invested in their IRA, but in their taxable account, they had the cash available for the strategy. Well, it was all liquid investments had in their IRA. So we said, hey, you can just sell everything in your IRA, rebuy it in your taxable account, and do this strategy in your IRA. So that's where the advisor will come in and create, find the best asset location for the strategy and to create the best outcome, even on a tax adjusted basis.
Perfect. With that, we've gone through the questions that we can get through for today's webinar. Want to thank you, Brett, for being here and putting this together and presenting. This was excellent. Want to thank everyone who was here today who participated. And again, just to reiterate, if you have any questions, please reach out to your advisors. Like Brett and I talked about a bit at the end here, we talked high level about these strategies today. The information that Brett covered is very important, fairly high level. We can get into the details. We can customize. We can make this very specifically tailored to whatever needs you have specifically or may need, right? So let's connect, talk to your advisors, find out where your needs and risk profile really aligns with these potential strategies, if this sounds like something that would be a good fit for you. And other than that, we'll leave you with that. Enjoy the rest of your day, and we will see you next time.